Hi guys, today we're gonna do a basic investment for chapter 11. This actually comprised of four different segmentation, so we will be having four different videos. Yeah. Okay, as for the learning objective, we have 5 learning objectives today. Firstly is to set your goals and be ready to invest. Second, calculate interest rates and real rates of return. Thirdly, manage risks in your investment. Fourth, allocate your assets in the manner that is best for you. And fifth, understand how difficult it is to beat the market. As for introduction, investment and or investing goals should be to protect and to make money. So it's important to understand investing from a common sense perspective, and you need a solid grounding in investing that will help you to reach your financial goals and to avoid pitfalls. Before you invest, you decide what are your goals. Yeah, you need to know what do you want from this investment, how much do you want it, how much you may want to set aside to meet those goals, and you need to know the difference between investing and speculating. Speculation is an asset whose value depends solely on supplies and demand, as opposed to being based on the return that it generates. For example, gold coin and baseball cards are worth more in the future if someone is willing to pay more for them. So there is an element of speculation there. It could worth more or it could not worth anything. So like I said earlier, investment supposed to generate returns. It's supposed to be an income return. Meanwhile, speculation is an asset whose value depends solely on the supplies of demands of it. Meaning to say, if a lot of people are looking for it, a lot of people want to have the same item or same assets, then the prices will spike up and the value of those items will increase. But what if the demand is not there? So the item will drop tremendously. So derivative securities value derived from value of another assets. There are many derivative securities are securities that are used to hedge against interest rates dropping. Yeah. So options are another another hedging tools that helps that gives the owner the right to buy or sell an asset at a given time. For example, if you have the right to buy, that is call options. Yeah, the right to buy. Meaning to say, if let's say at a stated price, so if the price goes even higher, you can manage to pay at a lower price, at your call price. So that will be an interesting options that you have. So how do you set your investment goal? Firstly, you need to write down your goals and you need to prioritize them and attach costs to them. Figure out when the money of those goals will be needed, and periodically re-evaluate your goals. Okay, for example, if you may want to ask questions to yourself, if for example, if I don't accomplish this goal, what are the consequences? These are the questions you question yourself. Or you can question yourself by asking yourself, am I willing to make the financial sacrifices necessary to meet this goal? Or how much money do I need to accomplish for these goals? And when do I need this money? These are the questions to actually giving you ideas of setting out your goals. Okay, there are two sets of setting investment goals. Formalized goal, we have 3 types. That is short term, within a year; intermediate term, 1 to 10 years; long term, that is 10 years. Okay, goals should be realistic. You should ask a question like, these are the questions that you need to ask. What if you don't accomplish it? What will happen to you? Are you willing to take the losses. How much money is needed? When do you need the money? So this is a financial reality check. Have a grip on your financial affairs. Make sure you are living with your own means. You are not following your friends. These are not pressures from some colleague or families to invest. You need to have adequate insurance and keep emergency funds. This is important if anything happens, especially if it's health related matters. Okay, what do you need to do when you're starting your investment program? Pay yourself first. First, set aside your saving, and what's left becomes the amount you can spend. When you pay yourself first, you're acknowledging the fact that your long-term goals are paramount. Second, make investing automatic. If your employer allows automatic withholding, take advantage of it. Have an amount automatically deducted from your checking account or your savings account and send it to a brokerage firms or mutual funds. So you're making a standard instruction to your employer to deduct certain amount of money for your investment. Take advantage of Uncle Sam and your employees. Uncle Sam is actually the money, yeah? If your employer offers matching investment, don't pass them by. Matching investment are about as close to something for nothing you will ever get. So keep your eyes on investment that are tax favored, such as there are investment that are tax. You are the income from those as investment are exempt from tax. So this type of investment you should take advantage of. Windfalls. If you're ever lucky enough to receive a bit of windfalls, perhaps an inheritance, a salary bonus, a gift, a tax refund, or maybe something from the lottery, the Muslim cannot do this. Don't fritter it away. Investing some or probably all of it in a speedy way to build up your investment. And then make 2 months a year investment month. Some financial advisors suggest that if you're having trouble starting your investment program, pick 2 months per year to cut back on your spending and make those your investment month. If you know that your life of poverty is over at the end of the month, it may be easier to stick to your saving, rather than investment, or else you become very poor life at the end of poverty. So this is not advisable if you don't have that. Alright, fitting taxes into investment. Compare investment return on a after-tax basis. You need to know that all investment income is taxable. This is additional income and it should be taxable. So when you want to compare the returns, you should compare it after tax. So there are marginal tax. That is the rate you pay on the next income or the next earning. So you also have tax-free investment alternative that should be compared on the after-tax basis. Of course, the higher your marginal tax bracket, the more attractive tax-free investment become. Okay, and then investment on the tax-deferred basis, which means that is not only does your investment grow free of taxes, but the money you invest isn't taxed until you liquidate your investment. Meaning to say you churn your yields, And then with taxes, capital gains and dividend income are better than ordinary income. So both long-term capital gains tax rate and the tax rate on qualified dividend are reduced to 50% for taxpayer who are top bracket exceed 15%, and for taxpayer who are in the 10 or 15% bracket, the tax rate is reduced to 0%. Meaning to say investment helps actually, the capital gain and dividend income helps actually to reduce the taxes, whichever bracket you are. So remember when we did taxes, there are brackets where your income starts, so and then it reduces it. Investment choice. Okay, you have two types of investment choice. The first one is actually lending investment. These are savings accounts and bonds which are debt instruments issued by corporation and governments. And you also have ownership investment. These are stocks and common stocks which represent ownership in the corporation along with income producing real estates. Okay, these are the type of investment. Okay, let's move to lending investment. Yeah, the first one, lending investment. Usually it has, for example, bond have maturity dates and they have par value or principal. These are the principal value that you should pay. Usually on a bond it should be 1,000 or 100, and it has coupon interest rate, that is the interest rate that will compound it every year. So you know ahead of time what will return will be. So if the issuer goes bankrupt, bondholder can lose the entire investment. Bond usually is for a long-term investment. It's very long-term investment. Yeah. Ownership investment. The first one is real estates. That is your home, rental apartments, and investment in the income-producing property. This are illiquid and hard to sell off. Okay, it takes a while to sell off. And stocks, fractional ownerships of a company. You buy stocks in company. You own it as a fraction of a corporation. And owner or equity holder, you own stocks. Yeah. And dividend, a payment by the corporation to its stockholders. So you earn your dividend every year if you buy stocks from corporation. Okay, return on investment. What do you get if you invest? Okay, you get capital gains or capital loss, gain or loss on the sales of the capital assets. Income return is any payment you receive directly from a company or organization which you invested. Okay, this is what you get from investment. Okay, this is what you need to know. Yeah, market rates, interest rates. You need to understand interest rates. Interest rates affect the value of the stocks, bonds, and real estates. Interest rates also determine earnings on saving and tied closely to inflation. Okay, there are two types of interest rates, market interest rates. First is nominal rate, and next is the real rate of return. So I think you did this on your financial management for BT 11203. So these are nominal or quoted rate of returns are the rate of return earned on investment without any adjustment for inflation. Meanwhile, real rate of return is the current or nominal rate of return minus the inflation rate. Okay, so these are the two types of market rates. So nominal interest rates have dropped somewhat over the past 20 years. Yeah, real rate of return can be calculated by subtracting the inflation rate from nominal interest rates. So real rate of return can be negative after you subtract with the inflation rate. The higher the inflation will bring you a negative interest rates. So this is the inflation rate from 1980 to 2010 in the US. So yeah, you can see there are four types of stocks here. We have corporate bonds, we have 10 years mature treasury bonds, we have 3 months treasury bills, and inflation rates. So the rates are gradually dropping. So how does these interest rates affect return on other investment? Expected returns on all investment are related. So what you can earn on one investment determines what you can earn in another investment. So interest rate acts as a base return. So when interest rate goes up, investor demand a higher return on other investment. What are the trade-off? So the risk and return of trade-off, risk is related to potential return. The more risk you assume, the greater the potential reward, but also the greater possibility of losing your money. So you must eliminate risk without affecting potential returns. The balanced amount of risk with amount of return is needed. You need to balance both. You need to be able to understand. You need to be able to actually diversify so that you'll be able to balance out. So you need a hedging tool, so that if you invest in stocks, the market is going down, at least your derivative will be able to help you to gain some money to offset the losses that you make in the stock market.